You probably imagine national debt as a single massive IOU to a foreign superpower. The real answer isn't nearly that simple or that sinister. Honestly, the money isn't owed to any one person or place in the way you're thinking. Think of it more like a web of financial promises, stretching from your own living room to central banks across the globe. A huge chunk of this debt is actually owed to a country's own people and institutions. That means ordinary citizens can be both the debtors and the creditors at the same time. But how does that even work? Look, when a government needs cash, it doesn't just knock on a neighbor's door. Instead, it creates and sells bonds, which are basically formal promises to pay back with interest. Your pension fund might buy a chunk of those bonds to secure its future. Your local bank probably holds a stack of them as safe assets. Even your aunt's retirement account could own a tiny piece of the national debt. So a lot of the money circulates right back into the domestic economy. But then who owns the rest? Here's where it gets more complex. Foreign governments and investors hold a significant portion too, but not in the way you see in movies. They aren't shadowy figures calling in loans to exert political pressure, at least not usually. They're often other countries looking for a safe place to park their excess savings. Sometimes, the biggest foreign holder of a nation's debt is its geopolitical rival. Isn't that a strange financial paradox? Now, let's break down the biggest players you've likely heard about. Central banks, both domestic and foreign, are absolutely massive holders of this debt. A nation's own central bank can buy government bonds in a process you might know as quantitative easing. Foreign central banks, especially in export-heavy nations, buy up debt as a way to manage their own currencies. So, the list of creditors is incredibly diverse. It ranges from the Chinese government to the retirement plan of a teacher in Ohio. It includes Japanese insurance companies and sovereign wealth funds from oil-rich nations. Even private hedge funds and individual investors worldwide trade these bonds every second. The system is deeply interconnected, and that's its greatest strength and weakness. But this leads to a very pressing question. If everyone owns the debt, does that mean no one is truly in control? The truth is, control is fragmented, and that creates a unique kind of stability. A government is far less likely to default when it owes money to its own citizens and powerful domestic industries. Conversely, owing too much to external creditors can be risky. History shows us that this external debt is where crises often begin. Remember, a government bond is considered one of the safest investments on earth. That's why demand for them is almost always constant. But safety is a relative concept, and it depends entirely on trust. What happens when that trust starts to fade? We'll need to look at the mechanics of a potential default. For now, just know the creditor isn't a lone supervillain in a skyscraper. It's a vast, diffuse network of financial interests, and you might be a part of that network without even realizing it. Your bank's stability, your pension's value, they're all tied to these government promises. So the next time you hear a headline about soaring national debt, think about that web. It's not just numbers on a screen owed to some anonymous entity. It's a reflection of global confidence, or sometimes the lack of it. The real power lies in the collective belief that the debt will be honored. But where did all this debt actually come from in the first place? That's a story of wars, crises, and very deliberate economic choices. Let's pause here for a moment. Most people assume governments go into debt because they're irresponsible with spending. The reality is, debt is often a deliberate and calculated tool, not just an accident. Honestly, it frequently starts with a major crisis, like a war or a recession, where spending suddenly can't be avoided. Governments then face a simple choice: raise taxes immediately or borrow money and spread the cost over time. They almost always choose to borrow, betting that future growth will make the debt easier to handle. But what happens when the crisis passes and the debt remains? That's when routine government budgeting kicks in, and deficits can become a permanent feature. Look, if a government consistently spends more on services and programs than it collects in taxes, it must borrow to cover that gap every single year. So the debt isn't just from one big event, it's often the slow accumulation of annual shortfalls. This is where politics plays a huge, often messy role. Promises for lower taxes and better services are popular, but they rarely add up without borrowing. So who actually decides to create this new debt? It's a Treasury Department acting on the orders of the political leadership, authorizing the sale of new bonds. These bonds are then auctioned off to the highest bidders in the financial markets. And here's a curious hook. The interest rate the government pays is set by these daily auctions, not by politicians. That rate tells you everything about what the market thinks of the country's financial health. A low rate means strong confidence. A high rate signals serious doubt. But can this system just go on forever? Theoretically, yes, as long as investors keep showing up to buy the new bonds. The danger isn't the debt itself, but the cost of servicing it, those regular interest payments. If interest rates rise sharply, those payments can skyrocket, forcing brutal cuts to other spending. Now, let's talk about a concept that often gets misunderstood: printing money. Can't a government just print the money to pay off its debts? Technically, yes, but doing so carelessly is a recipe for destroying the currency's value and causing hyperinflation. That's why most developed countries let their independent central banks manage the money supply separately from the debt. But the lines can blur in times of extreme stress. You see, a central bank buying government debt is functionally similar to printing money to fund the state. This is the modern magic trick at the heart of many economies today. It keeps interest rates low and allows governments to borrow cheaply. But what's the exit strategy? Nobody really has a clear answer for that. The system relies on a delicate balance in the hope that economic growth will outpace the interest. When growth is strong, debt as a percentage of the economy can actually shrink. The problem starts when growth stalls for a long time. Then the debt burden feels heavier and heavier. And this brings us to a critical distinction: debt owed in your own currency versus debt owed in a foreign currency. This might be the single most important factor in a country's financial fate. A country like the US or Japan owes almost all its debt in its own currency, which gives it a huge escape hatch. A country like Argentina or Sri Lanka, which borrows in dollars or euros, has no such luxury. Why does that matter so much? Because if you owe money in your own currency, you can always create more of it to make the payments, even if that devalues it. If you owe in a foreign currency, you must earn or borrow that currency, and you can truly run out. That's when a real crushing default becomes almost inevitable. So the who you owe is deeply connected to the what you owe them. Let's stop here and consider the real-world consequences of that difference. So if a nation can't pay, who actually loses the money? It's not a single entity that takes the hit, but a cascade of investors, pensioners, and everyday citizens. First in line to feel the pain are the foreign bondholders who see their assets become worthless. But domestic banks, stuffed with government bonds, would face instant collapse, freezing the entire economy. Your local pension fund, a major bondholder, would suddenly have a giant hole in its finances, and the government itself would be locked out of international markets, unable to borrow for years. This isn't a theoretical exercise. We've seen it happen time and again. Look at Greece during its crisis. The debt was largely owed to other European governments and banks. The resulting austerity measures were brutal for the Greek public, even though they weren't the primary creditors. Honestly, the pain always ripples down to the population through lost jobs, eviscerated public services, and shattered savings. But here's a twist that might surprise you. Sometimes, a government deliberately defaults on debt held by foreign speculators, believing it can protect its own people. The calculus is cold but simple. It's politically easier to stiff outsiders than to impose suffering on voters at home. Yet this gambit destroys international trust for a generation. Now, let's circle back to our original question with a clearer lens. When we ask who are they owing to, we're really asking who holds the power and who faces the risk. The power isn't with a single creditor, but with the collective market's willingness to keep lending. The risk is distributed across the globe, from a retiree in Berlin to a mutual fund in New York. This system creates a strange kind of mutual assured financial destruction. Major economies are so intertwined that a serious default by one could trigger a global crisis. That interconnectedness is, ironically, a powerful deterrent against default. So, is there a limit to how much debt a country can take on? There's no magic number, but there is a point where the trust simply runs out. Economists look at debt to GDP ratios, but the breaking point is different for every nation. It depends on politics, demographics, and whether the borrowed money was invested or simply spent. What did the debt actually buy? If it built productive infrastructure or educated a generation, the future might handle the burden. If it merely paid for recurring expenses, the future gets poorer. This leads us to the final, sobering reality. The true creditor isn't just today's bondholder, but tomorrow's taxpayer and the next generation of citizens. They are the ones who will ultimately service this debt or live with the consequences of a crisis. Debt is always a claim on future income, a transfer from the future to the present. So, in a very real sense, nations owe money to their own future selves. And that future is less about distant banks and more about the opportunities available to your children. The web of debt is, fundamentally, a web of promises between the past, the present, and what is yet to come. When those promises are broken, the fabric of society itself can fray. That's the ultimate answer to the question of who is really owed.